No matter who you are, no matter where you are, it seems to be that there are always people telling you that the real estate market is about to collapse. They jump out of the bushes at this point. The crash is coming. Just wait. We're almost there. It's all about to crash and fold and fall apart. People have been saying this for years and probably a lot longer than that. And over history, occasionally, of course, they are right because there have been real estate crashes throughout history. But at least over the last 4 or 5 years, everyone who said this, and there are plenty, have been proven wrong. So this is my every so often check-in on the state of the impending real estate crash to determine what's true and what's not. Because that's how real estate market crashes happen. It's based on very specific economic factors, not just based on hope or vindictiveness. And I'll tell you right now, off the top, there are not the factors present right now to necessitate a real estate market crash, despite the fact that home prices have gone up so much and stayed relatively high, and home affordability is very, very bad right now in the United States. That is why all the real estate market doom and gloomers have been wrong over the last 5 years, and that is why they will continue to be wrong, at least in the short term. But looking at the data, I do believe that there is a significant change to the real estate market cycle on the horizon, and I do want to tell you about that in this video too. So please stick around, allow me to explain. For those of you who don't know, my name's Sam Newman. I'm a Denver real estate agent, and I am the host of this fun channel here. Sometimes we go out and do food reviews and tours, and sometimes we just talk about the real estate market. If I can be any help to you in terms of real estate questions, please do reach out. I love it when people reach out from the channel, and the team and I would love to be at your service if we can. Okay, so first off, who's calling for a crash and why are they saying it? Well, short answer, a lot of people and for a lot of reasons. But one in particular, this guy, Nick Gurley, he owns this channel called Reventure Consulting on YouTube. Very, very popular channel. Gets a ton of views, and it's almost exclusively videos about how the real estate market and the broader economy is about to completely collapse. Is currently collapsing sometimes, but is really, oh, we are on the verge, we are on the precipice of a total and utter meltdown. Seriously, you can look at the channel and find dozens, probably hundreds of videos saying the meltdown is happening. It starts now. In fact, he just recently posted a video, because I just checked out the channel, that said it is 2008 all over again, which is very fun. And I should mention a very popular topic too. Doom and gloom always gets people to click. So I'm sure Nick actually believes all this stuff, but by making all of these videos saying the sky is falling, he has grown a very, very big, very, very profitable YouTube channel. And he's kind of been doing the same thing for years. You can look a year ago, it said this is the start of the crash. Even going back to 2021, you can find a video where he says, hey, I'm calling it. This right now, here in 2021, is the beginning of the real estate market crash. Now, obviously, that was wrong. He's been wrong actually every time he said it. And maybe the argument is, no, just wait. It's still coming, which I guess is always technically true if we don't have a time limit on it. But I think reasonably we can look at this and say, hey, calling for a real estate market crash in 2021 was really wrong, especially since prices rose significantly from 21 to 22. And if you were planning on buying but didn't because you were expecting a crash, then you missed out on a lot of equity and you missed out on a really good interest rate that you're never going to see again, probably. And that's why I bring this up. That's why I even talk about this topic at all, because it's really important when you're taking advice that's based on questionable data and maybe some ulterior motives that can cause real people to make real bad decisions when it comes to buying or selling a home. And you may say, Sam, you're a real estate agent. You also have ulterior motives. And I understand that point of view. Sam, it is in your best interest to convince people to buy homes. In a way, I get that, but here's the deal. I stopped doing that a long time ago. Number one, it's actually really hard to convince people to buy homes. They either want to or don't. And number two, I have found that the best way for me to be successful in my business is to give people honest, accurate data, the truth, to give them the truth. And that's what I've been trying to do on this YouTube channel. And so I don't think it's a great time for everybody to buy. And I've talked about that in recent videos, and happy to talk about that with you directly offline. I also don't think it's a great time for everybody to sell. I have tried to encourage so many people people in specific situations to hold on to their home and to rent it out until market conditions get better and they can have a more profitable sale. And listen, I like videos that do well. I like getting views, so I'm not throwing shade at anybody else, right? I'm on YouTube here trying to do eye-catching, engaging content that will get people to watch. Obviously, that's the whole game. But when you build a channel, when you build an entire brand based off of the real estate market is crashing and you've been wrong from the beginning till the end, that's a little different. And that's just one example. Okay, this Reventure consulting thing, you see it everywhere. I get comments on my videos all the time telling me the same thing. The real estate market is going to crash. Now, when you ask for data or any other information to support that, typically what you get is something like, well, prices are high. That is true. Prices are historically high in many areas of the country. And by the way, since I am located in Denver, I often look at this through the local Denver real estate market lens. I'm going to look at a lot of national data today. I'd say most of it applies here locally in Denver too. Our Denver market tends to be a little more resilient than the broader national market, but they do follow the same trends. But purely high prices don't necessitate a real estate crash. You've seen that even in 2022 when prices topped out and hit the tippy top of the market and interest rates shot up. Prices have only come down since then, 3 to 4% depending on where you're looking. Again, much more in certain markets, less in some markets. But I bring this up to point out that a lot of the arguments in favor of a real estate crash aren't specifically data based. Sometimes you say, oh, hey, what's that based on? That the market's about to crash, and you just get, watch, just wait, just watch. And that's my favorite one. It's like a drunken uncle at Thanksgiving explaining why the US is about to go to war with China or something. There are other reasons to assume a real estate crash is on the horizon. The biggest one, I think, is because it feels like a crash is coming. When you look at the factors present right now in the American real estate market, real estate economy at large. And affordability is a big one. We will talk about this later in the video, but housing affordability right now is maybe the worst it's ever been in American history if we adjust for inflation. And that is one thing that can help cause a severe downturn. On its own, though, it doesn't. Why do we know that? Because affordability has been really bad for at least 2 years. 2 years, not a real long time in a real estate cycle. A typical real estate cycle averages about 18 years. Again, we will get to that. But when people say a crash is coming, what are they saying? Well, usually when people talk about a crash, they're talking about a big drop in home prices that happens relatively quickly. And we're talking about a drop of 20% or more, 25%. That would be huge. That would be when we take the median home price here in the Denver metro right now, right around $640,000. That would be closer to $500,000. A big change. And for prices to come down that much, it's really not that complicated to understand what has to happen. You probably understand the concept of supply and demand. It's like the most basic economic concept of all time. Everybody learned it in school. When we have low supply, like we do have right now, demand has to drop a ton for prices to then come down to match this 25% drop that people are calling for. Right now, if you look at supply, we can look at active housing inventory in the United States, and you see this graph. This only goes back to 2016 by the St. Louis Fed. You see where we're at right now. It's about 953,000 units. Okay, that bottomed out in earlier 2022. Okay, it was super low, and it's come up significantly since then. Okay, but it's still much lower than it has been prior to that 2020 COVID thing that supercharged the real estate market for a number of reasons. If you look back at 2016, 2017, 2018, those were very prosperous years in the real estate market in America. Supply was much higher, inventory was much higher than it is now. So this is the big problem we have, and this is the big thing that's stopping a crash from happening, essentially, is supply is still so low. And buyer demand hasn't come down enough. It hasn't really changed much. There's so many buyers out there still ready to buy a home. Supply has stayed low, keeping prices high. Now, the number of transactions has gone down. In 2024, nationally, it was the lowest transaction count in like 30 years. Significant deal because of these affordability challenges we're talking about. But on the balance, home prices still went up a little bit in 2024 because supply remains so low. A big part of that is this interest rate lock-in phenomenon that happened because during COVID, with these very ultra low interest rates, 3%, 2.75%. By the way, anytime you talk to somebody, it always gets lower and lower. Oh, I got 2.7. I got 2.5. People would be like, I got 2.25. Maybe not too many people got them that low, but point is, a lot of people got into via buying a house or via refinancing an interest rate that's very low, making a dramatic difference on that monthly payment. Okay, so now if you have a 3% interest rate, you're not moving for a 7% interest rate unless you absolutely have to. So these people who aren't selling their home would otherwise be selling their home, but that inventory is not hitting the market. That's one of the big things that's keeping inventory low. Over time, that lock-in effect will ease as the amount of money owed on those low mortgages goes down and they become less significant, and as life factors continue to spur people to move. At some point, you just have to say, when life tells you it's time to move, we need more space, we need to downsize, we need to move states, whatever it is, the interest rate doesn't matter as much anymore. That's when people move. That's the people who are moving now. That will continue to happen more and more over time. And by the way, if we look at local inventory here in Denver, paints a very similar picture, even more stark of a picture, actually, because this graph goes all the way back to 2005. So you can see when Nick says there's another 2008 coming, right? It's about to happen. We'll look at inventory. You can look at all these lines, but basically just look at this blue line. This is active listings, or this black chunk. This is months of supply. Two different ways to measure the same thing. Prior to the 2008, 2007 crash, it was much, much higher. Then, of course, it skyrocketed, but we're talking about 10,000 units in Denver back in 2005, whereas now, much, much lower. Current active units as of this graph, 6,700. And by the way, that's significantly higher than it has been anytime in the last 4 years. So right now, supply is too low to cause a big time crash in home prices. Will that change over time? Yes, of course, because everything does. And real estate, like every other market in the world, operates on a cycle. Again, we're getting there. And when we're talking about affordability, we can look at one more graph. This is kind of a real thin graph, so it may be hard to see. But right here, this is the home price to median household income ratio in the US. How much of their income people are spending on their house, basically. And the graph tells the story, basically. You can see it going up in 2005, okay? And then that came right before the real estate crash of 2007, essentially. You're seeing it's going up now. It's actually higher. So this is not insignificant. This is a warning sign. This is an alarm bell that the longer this goes on, the more it's going to put stress on the real estate market and the broader US economy. Granted, this isn't the only thing necessary to cause a crash. In 2008, you may remember, it wasn't just an affordability issue in terms of the amount of money people had to spend monthly on their home. It was that people literally couldn't afford the mortgage that they were being given. So subprime mortgages, it caused the entire crash, not just of real estate, but the global economy. The difference now is that those mortgage standards have been changed. They are drastically different. It's actually very challenging to get a loan, even if you can't afford it right now. They make you jump through so many hoops because of largely what happened in 2007, 2008. So that's the big difference here. But this is our main problem with the national real estate market right now, affordability. So the market's slow, very slow actually, but prices aren't dropping. For prices to have that big drop, we don't just need this affordability problem. We need another big event like widespread unemployment. People are spending a lot of money on their homes, and now all of a sudden people are getting laid off and they can't afford them. That causes homes to go into foreclosure, maybe, which is what kicked this whole thing off last time around. This chart is the civilian unemployment rate in America. And if you follow the economy at all, you know unemployment is very, very low. It has been low for a long time. It has ticked up a bit to just above 4% right now, but it is much, much lower than it was in some of our more challenging economic times. You see a big jump right there. That was briefly during COVID when everything shut down. And then it came down, honestly, pretty quickly. So the unemployment rate is still so low. And that's been a weird thing about the economy at large, is that it's been so resilient, even in the face of not just affordability challenges with housing, but everything. Inflation has caused everything to now cost $1 million. My wife and I were just talking about it at the grocery store. Normal bag of groceries is $75 now. It's insane. But the low unemployment is one of the big reasons we haven't gone into a true recession. People will say, oh, we are in a recession because it means XYZ. Maybe we are. I don't know. It certainly doesn't feel like a recession the last two times. I know we're basing things on feel now, but I think most economists would tell you we're not in a true or deep recession and have not been, even though there's some really challenging economic factors present. So to cause a crash, you need that employment rate to go up significantly, or you need to cause this mass wave of foreclosures, especially if we're talking about a crash on par with 2008, the foreclosure crisis. Here's the problem with that. This is a graph, also from our friend Fred, of equity, household equity in real estate. For those who own homes, this is the amount of equity across the board that they have. Look at this graph starting in basically 2012, where it's gone up. Now, again, there was a lot of equity preceding the crash, but it came down quite a bit going into 2007. and it is exponentially higher right now. Look at what this graph has done. And anecdotally, this makes sense. Okay, if you bought your home in 2019, even 2020, or any time before that, with what home prices have done, you have a ton of equity right now. Why this matters is because the more equity homeowners have, the less likely a foreclosure is. That's why foreclosures have been next to zero for the last 4 years. Because if you have enough equity in your home and you do lose your job or something else happens so that you are no longer able to afford your mortgage, you just sell the home. You make money, you go do something else. You are not being foreclosed on, you are not underwater. Now, this is not true for homeowners who bought in the last 2.5 years. If you bought 2 years ago and you're trying to sell now, and I talk to folks like this actually on a regular basis, that's a challenge. Chances are you're going to be taking a loss. That's one of the reasons I encourage people to stay in your home longer if you can. You bought at a much higher price point and you have a higher interest rate. This is the group that is at risk for foreclosure. The problem is that group is not that big. It's not the majority of US homeowners. I don't have the data pulled up right now. I shared it on a previous video a while ago, but something like 65%, maybe even 70% of US homeowners have a mortgage rate, an interest rate of 4.5% or below. Stands to reason. It's all those people who bought in 2020, 2021, plus all the people who owned before that who refied when the getting was really good in the refi boom. Lower interest rate means lower payment. Lower payment means less likely to be foreclosed on. So based on all this, we do not have the factors present for a major real estate crash right now. And it doesn't look imminent that those factors will rear their heads. Can things change? Obviously. Will they change at some point? Yes. And that's what I want to talk about next. Honestly, I think for all these calls, demands almost for a real estate crash, guarantees, sure, many of them come from nefarious points of view, grift, all those reasons are accurate. But honestly, I believe that a lot of it is just a confusion of a market crash with a market cycle. Again, a market crash is a major drop in prices, 20, 25, even 30%. That's what most people are talking about when they say market crash. But we are due for prices to come down some, less than that, but some, based on just the next phase of a real estate market cycle. To talk about this, we want to talk about an 18-year market cycle. This is an economic theory that goes back like 100 years at least. It's been sort of widely accepted that real estate markets, commercial and residential housing markets, operate on an average of an 18-year cycle. About every 18 years, give or take a few years based on what else is going on, things start to repeat themselves. And this is a graph of the cycle, and this is a little confusing. It's these quadrants, but basically it's 4 phases: recovery, expansion, hypersupply, and recession. So it starts at recovery after a market downturn, or if things are really bad, a market crash. This is where things are very slow. Things are starting to recover economically from the last time real estate prices came down, okay? That recovery phase is a long phase. Think about it from 2009 to basically 2014. It's slow, and even though it's called a recovery, it doesn't feel very good, and it's not much to write home about. Then we move into phase 2, expansion. Expansion is when the getting's good. New construction kicks in more because there's more demand for housing, but new construction isn't able to keep up with demand. The economy is doing better than it has been. Prices are going up. Been around recently, you know what expansion looks like. The phase after that is hypersupply. This is what I've been talking about previously in this video. When supply finally goes up higher than, exceeds the demand for homes. This is a process of a lot of that new construction finally kicking in, these new homes being built. It's also marked by increasing vacancy in the rental market, and that's something to keep an eye on because at least locally here in Denver, we are seeing that in the rental market, especially in multifamily apartments, condos, townhomes. There is a lot of vacancy in apartments right now, and that's something we hadn't seen prior to about 2023. And then after that comes a real estate recession, when supply finally overtook demand. Homes sit on the market longer, prices are cut more and more, and things probably aren't that great once again in the broader economy. It's a really simplistic explanation of this whole thing. Apologies, but the point is it's a market cycle which real estate works on. So does every economic market, really. So does the stock market. So does the general US economy. Everything is ebbs and flows. It's kind of funny when we have some sort of recession of any kind. We always freak out every time. Every time we freak out like we've never seen it before. But not only is it normal, it's a necessary part of any market cycle, even if it's no fun. So point being, if you're pointing to this phase 4 of this real estate market cycle, this recession cycle, as a real estate market crash, then yes, there is a real estate market crash coming because there's always phase 4 coming. When and how, we're not sure, but it's coming. But when people are putting up big, bold banners calling for a massive crash in real estate, I don't think this is what they're talking about. But when people see prices dropping and say, oh, things are crashing, this might be what they're talking about. It is a very real, very normal thing in the real estate market cycle. Here's the tough thing about this market cycle quadrant graph, or any market cycle at all. You don't really know where you are until later. We don't really know where we are right now, and it's kind of not impossible, but very challenging to know until later, until we have the benefit of hindsight. Many people think right now we are either in the very late stages of phase 2 expansion or the beginning stages of phase 3 hypersupply. I tend to think, based on what we've seen in the Denver real estate market especially, we're more in phase 3. We are more in the hypersupply market. We're going to see what the spring market holds, because there is a lot of pent-up demand that people just haven't been able to get into homes for one reason or another. It is forecasted to be a fairly strong spring market. We'll see. But with what supply has done, maybe we're not in hypersupply yet, but we're in much higher supply than we have been. The phase that follows that is always the real estate recession. Some drop in prices, some decay in the broader real estate market. So the point here is that is coming. When is it coming? Don't know. What's it going to look like? Don't know. Again, we would need a significant change to more than one economic factor to cause a huge drop in prices right now. It feels like it should happen, especially with where affordability is. But the factors just aren't. But the truth is, from the very high highs of 22, where prices peaked around June, we really haven't paid the piper yet. It feels similar to what's going on in the broader economy, where printed all this money, right? People were able to get into very low mortgages. It was a number of policy factors that created this inflation that we're dealing with now. Interest rates rose to adjust, but we still haven't had the recession that feels like we're owed. It feels the same way in real estate. They call it a soft landing. Are we able to get a soft landing and have phase 4 of this not hurt too bad, not be 10, 15% drop in real estate values, but only be a 5%, 7%. They've already come down 4 to 5. Where does that factor into this? At this point, I don't know. And one big confounding factor to this whole thing, this whole cycle, this whole conversation is 2020 and COVID. I just mentioned it, but so much happened during COVID that caused the real estate market to just get turned on its head. That is a variable that's not accounted for in a normal 18-year real estate cycle. Hyper low interest rates, government inventions, a general change in the way people lived, that some of that has continued. It's a huge variable, and we'll see what it means and how it plays out long term. Important thing to remember about this is, I think, two things. Number one, there is going to be a real estate recession phase. There's going to be a phase 4. There's going to be something. I don't think we've had it yet. Maybe we have. Again, there's no way to know where we are in here until we're out of it, basically. Maybe we have. It seems like there's more recession to come. It may take a little longer to get there. My guess would be we're in some phase of hypersupply right now. But after phase 4 always follows phase 1 and phase 2, recovery and expansion. So again, every time things are bad, we always freak out, but they have to be bad at some point. The line doesn't just go up every single day. It has dips. And after the bad always comes the good. That is why real estate is a long-term investment, and that's the big thing here. Our minds have gotten warped to that a little bit over the last few years, when you could buy in 2019 and sell in 2022 and make 35% profit, 40%, 50% in some cases. That's not how it usually works. That is part of that confounding factor. But if you think about this in a long-term perspective, it is a good investment. And I want to bring up one more thing right here. This is from Byron Lazine. He's a real estate guy on the East Coast, works with BAM, who's a real estate kind of news and content outlet. He actually reposted just the other day, I just saw this, one of Nick Gurley's Instagram posts that shows a graph of the value of homes in America since 1924. Nick was probably trying to say something different with this, but Byron just points out, even the internet's biggest real estate doomer understands this simple fact. Real estate values always go up and to the right. At least they always have in history. Are there going to be dips in there? Yes. It's necessary. But if we think about this from a long-term perspective, we're going to be okay. And timing and when and how to do things always depends on your individual situation. So if you would like to discuss that, please do reach out. I'd love to have that conversation with you. Otherwise, you're the best. Comments ought to be fun. See you next time.